Current state, I think, is very much a panic, unfortunately. Things are being taken much further than they should be. So typically, the biggest damage that comes to markets from concerns like the coronavirus or prior epidemics in history is just the reaction of people panicking.
And, is it an overreaction in your estimation? Or is this kind of what you maybe would anticipate with something like this?
No, actually, it's an overreaction. I think what's interesting is you go back and look at the history, and I'm not a physician or a epidemiologist, but every year, according to World Health Organization numbers.
You could just set that down.
Okay. The flu, every year the flu kills 300,000 to 600,000 people around the world. So right now we're at, I think, 83,000 cases of coronavirus that have been identified, pushing 3,000 deaths. So on a relative basis, despite of all the tragedy, it's really not horribly unusual, and the world survived much worse. So I think with that perspective, this is an overreaction so far. People are fearful, which is understandable, but probably too fearful.
Gotcha. And obviously people here at home with their 401ks and the stock market, the effect it has on that, should they be concerned?
You're always concerned when you see the value of your holdings going down, but what people should be really aware of is if you go back to the prior epidemics that I mentioned, so whether it's SARS or MERS or HIV, there's probably 10 or 12 of those over the last 40 or so years. The market tended to react negatively initially, but within 6 months, I think it was positive every time. And right now, with the damage in the market the last 3 days, there's been 7 or 8 times that's happened since 1950, where we were at a high, not very long ago, 2 weeks ago, and now we're down from that high 10% or so. Going back to those previous events, the market again was positive 6 months later. So the last thing people should do right now is probably any moves. Just kind of write it out, and hopefully they've got the right asset allocation for themselves that lets them do that. But don't panic with your investments.
If someone sees this kind of thing happening and they think, why does a virus have an impact on the stock market the way it does? Can you just speak maybe a little bit to, why a virus that seems primarily to be affected China at this point has such an impact on U.S. markets?
Well, the fear is the world economy is slowing down, and there's actually some evidence of that because of the panic. So you get your worst stock market reactions when you're pushing a recession, whether it's domestically here or globally. So the impact of the virus and people's reaction to it is basically economic activity is slowing down. And the fear is that will kind of roll into a much bigger event and therefore cause a recession, which will cause earnings damage, which will then cause stocks to be overvalued and the price going down. So there's a reaction right now in fear of that, of this all blowing up into a big recession.
And then we've heard the term correction quite a bit. What does that mean?
A correction is any time that the stocks pull back in price. So I think what most people don't understand is corrections happen all the time. And even though it feels bad this time and the rationale for it is the virus, I think I'll get this wrong, but we have at least a 10% correction at least once a year, many times even twice a year. So again, going back to use history as a guide, since 1980, there's been an average decline at least once a year of 13 or 14%. And of those 40 years or so, the market's ended up positive 30 out of 40 times. So when you put things back into perspective a little bit, it helps not to let that panic button, push you, and maybe you push it or you don't push it. So.
Right. Okay. And is any of this comparable to 2008, just as far as when it comes to the level things are at right now? I mean, clearly we're not in a recession, but is there any similarities to that?
I don't think there really are. 2008 was actually an event that was definitely heading into a recession, and there were some really unusual things that happened in the financial markets, particularly the housing market. where there's just a lot of bad debt that surfaced. None of that's happening now. We're not facing a recession. The stats that way look pretty good. Actually, prior to the virus rearing its head over the last few weeks, world growth was starting to pick up. So I don't think there's any really parallels to 2008. And 2008 got so bad that at its peak, the market was down, I think, 38 to 40%. So we'd have a long way to go before we get to that kind of territory.
And you had touched on it briefly about, just not making any moves maybe right now. So what are the things people should avoid doing with, the market in the state that it's in right now?
I would say avoid, again, making any major changes to pull money out. If people are really concerned and they want to take some profits off the table, I would wait for a rebound. Typically, we're going to have a rebound. I don't think this is going to be a straight downward move. And as I said before, if you go back using history as a guide, when we've had these kind of corrections within 6 months, the market was positive practically every time. So have some patience. If you see a rebound and you want to take some chips off the table, do it at that point, but not now. I do think this is an opportunity for people to be looking maybe at their buy list. Look for stocks that they think are really good companies that have been beaten down in price, and prepare to buy in once things stabilize a bit.
Okay. All right. Is there anything else you'd like to add or mention, or that you think is important for people to know that I didn't ask you about?
No, I think we covered it quite a bit, and I think the key thing is everybody keep a cool head, and these things tend to work themselves out in a positive way.